Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
Well, good morning everyone, and it's another Thursday, just after 10, and it's time for Financially Raw. Thanks for joining me, and that was Money Talks from ACDC, and it was the choice of our special studio guest this morning, Mr. Japie Venter. Japie and myself has come a long road together, and Japie's got lots of experience in the financial services industry, specifically regarding risk, and that is the topic that we're going to discuss today, is how to minimize your risk. So Japie, if you want to take a minute or so, just tell the listeners who you are, where you come from, what your experience is, and then we can get into it.
Yes, Lourens, thank you very much for having me, and welcome to our listeners as well for joining us this morning. Yeah, Lourens, I started in the insurance industry 23 years ago. Started off at Santam, helping people with their short-term insurance, car and household insurance. From there, a year or two later, I helped people, or I helped Santam more specifically, to start a resource center. At the resource center, we focused mainly on helping specific brokers to accommodate them with a one-stop shop where they can get all their short-term risk needs met at one central point instead of having to speak to 20 or 30 different departments. Then in 2001, you and I started Retire Rich and Happy, so long ago already. And yeah, from there, I've always had a passion for risk cover, understanding risk, understanding how we can position risk cover to benefit clients instead of positioning it in such a way that it benefits insurance companies.
Yes,
so,
that's important.
So people can actually benefit from it.
Yeah, that's so important. And like I said, today we're going to talk about minimizing your risk, which is basically the second step in our 5-step process. So for those of you who don't know our 5 steps, this is the foundation of our business. The step 1 is invest in yourself, which focuses on financial education, improving your financial intelligence. Step 2 is minimize your risk, which is the foundation of all financial plan. Whether it's a business financial plan or a personal financial plan, minimizing your risk is crucial. The next step is to become an entrepreneur, create multiple sources of income. And then the next one is invest in income generating assets. And the 5th one, paying it forward, obviously. For those of you who are listening, if you want to get a little bit more information regarding our 5 steps, you're welcome to visit our website, retirerichandhappy.co.za. You can follow us on Facebook, Retire Rich and Happy, and then follow our channel on YouTube. All of these shows get put onto YouTube as video, so you can see us in the studio chatting as well. Get to see who we are, and yes, go listen to it a second time. It's always good. You always get more information the second time you listen to something. So Japie, so like we said, minimizing your risk is so important. But I think if you can share with the listeners, why is this such an important step, and your experiences when people don't have it in place, or when people don't put effort into minimizing their risk.
Definitely. Lourens, I think in order to understand minimize your risk, we have to take a little step backward and first understand what exactly risk is. Risk is minimizing the actual financial loss of something happening to you. You can pass away, you can become disabled, laptop can fall off the table, you can have an accident with your car. So the concept of risk cover is to put somebody in the same position they were before the loss. And that's very, very important. Risk cover is not a savings plan. Risk cover is not something you take out to enrich yourself. So you don't want to be in a situation where if you should pass away, the wife can go and buy a Ferrari or Lamborghini. We have to identify the actual need. From there, risk cover can be divided into two very broad categories. We've got long-term risk and we've got short-term risk. Long-term risk would be your traditional life cover, disability, income protection, dread disease. And short-term risk would be your car and household contents. I usually explain it to people in the form of long-term risk is yourself and things that can happen to you, while short-term risk are things that you own, things that you handle, things in your control. So defining those two separate things, we have a better understanding of what exactly needs to be covered and how we should calculate that loss.
Yeah. Just quickly, one thing that you mentioned, I don't want to go too far before we just touch on that, is that people need to understand is, and we talk about what if money. Money that you pay into risk is what if money. It's money you pay a third party for in case something happens to you. And we're going to touch on it, I think, a little bit later. But what I want people to understand is that when you take out a life cover policy, when you take out a short-term insurance policy, it doesn't build an asset. It doesn't build anything that's going to come back. Doesn't matter what these marketing guys try and tell you. And we'll get into how they pay you your own money back a little bit later. But people need to understand the money they spend on risk is money that is gone. And I think we can chat a little bit later about the gambling arrangement that you basically have with an insurance company. Or maybe you want to touch on it now, how that gambling arrangement basically works.
There's two things we have to realize, Lourens. Like you pointed out now, the whole concept of risk as an asset. You know, we were all raised saying that you need to take out life cover and have a policy in place, and then you need to pay it and pay it and pay it, with the hope that somewhere along the line something does eventually happen to you, and then the policy would eventually, hopefully, pay out. Over the years, I found that people have this backwards. Like you say, risk cover is not an asset. So it's not something you want to keep on paying. By no means am I saying risk cover is unimportant. It's extremely important. It's the basis of your financial planning. But that's where minimize your risk comes in. We want to minimize your risk on two fronts. The first one being minimize the actual financial loss of something happening. And secondly, minimize the amount of money you pay into risk. Because you want to use that money to build assets, to invest in yourself. Just coming back to the whole gambling arrangement. This is probably the easiest way to understand risk cover. You go to an insurance company and tell them, I bet you I'm going to have a car accident, I'm going to pass away, I'm going to become disabled this month.
Yes.
They then ask you a lot of questions, send you for medical tests, you have to take your car for testing, and they come back and say, nope, nothing's going to happen to you this month.
Yeah, you're going to be okay.
And you say, nope, but
you're the eternal pessimist. I am going to die.
But I'm definitely, something is going to happen.
Yeah.
I bet you $1,000 something is going to happen. The insurance company then goes and says, we're so certain nothing will happen that if something should happen, we'll give you R1,000,000. So you both put your money on on the table. You put your $1,000 down. They put their $1,000,000 down. If something happens to you during that month, then yay, you win.
Yay. Yeah.
You get to keep the R1,000,000, or your beneficiaries get to keep it. If nothing happens, then you lost. The insurance company gets to keep your R1,000. So they are under no obligation and they will never pay it back because they won the bet.
Yes.
And this thing keeps on repeating itself. So next month you make the same bet, and the month after, and the month after. And that's why we need to realize what the actual financial loss is and how to calculate that financial loss and use the money wisely. Like the song pointed out, money talks. We have to listen to it.
Yes. Yeah, so that gambling arrangement is something that people need to understand, because there's so much running around in the market about if you put your life cover with us, we're going to pay you all your money back in 15 years.
Don't get me started on those things.
We're going to talk about it. I'm going to get you started. So we're going to give you all your money back, or in 5 years, we're going to give you this bonus, or if you do this or do that, you're going to jump through this hoop or that hoop, we're going to give you extra cover. So one of the things that is a very big focus of ours is the approach that you have to have towards risk. The problem I have with the industry is that most of the time, whoever sees you, the financial advisor, the broker, the whatever they call themselves, they come out and their approach to risk is to focus on what have you got. And then they try and beat what you've got. So they go and they get you a new quote and they say they're going to give you a little bit more cover for what you're actually paying. And then they'll give you a bonus or whatever the case may be. And then you move. But you don't know if that's actually what you need. What does it do? So our approach is, what do you need first? And I think that is what is important, that people look at their risk not from what they've got and beating that, but from the perspective of what they need. So if you can maybe, I see you want to jump in there, but if you can maybe just share with the listeners how we should approach risk, what is the process we go through to make sure that what the client has is actually what they need.
Yes, Lourens, to touch on the first point that you mentioned, the whole bonus structure, we have to remember there's no such thing as a free lunch. Anytime any company tells you that they will give you money back, they are basically giving your own money back. So if you look at the little ads on TV, right at the bottom of the screen, it helps, of course, if you have one of these real big screen TVs.
Yeah.
But at the bottom of the screen,
that you have insured, obviously.
Very much. You will see it says that your payout bonus constitutes about 6 to 10% of your premium paid.
Yeah, one company actually it's 30%.
Very much. So what the insurance company actually does is it calculates the amount they need to charge in order to give you the risk cover, loads an additional premium onto that. They keep that additional premium for a time, 5 years, 10 years, 15 years, whatever the time frame may be. They get to invest that additional premium. They get to get returns on that premium. And at the end of the day, they just give you your money back. If you've jumped through all the hoops.
Yeah, exactly.
If you've made certain that you did not claim. If you make certain that you had all the premium increases and you went through all the medical tests and you jumped through all the hoops, then maybe you can get your money back.
Yeah, that's exactly it. It's like you go to the bank and you say to them, listen, I want you to take 1,000 Rand a month from my money, put it in an account, and then you tell me the rules. Tell me everything that I need to do to go and get my money back. If I don't do what you decided I need to do, then you can keep my money. I don't want it anymore. That's basically the principle, because what happens is that, let's say you would have paid 1,000 Rand for that risk. You're now paying 1,300 for that risk. That extra 300 Rand they keep. And more often than not, the people that do this don't reach the term, or they don't jump through all the hoops, and they bargain on it. So they might only pay back 1 out of every 10 people. I don't know the exact stats, but 1 out of every 10 people's money to them. The other money they keep. It is a brilliant business plan, just not in the client's best interest.
If you actually go and look at these statistics, Lourens, 86% of people who make use of a sort of payback scheme never get their money back.
Yeah. And it all started with a short-term insurance company. We're not allowed to name purple names, but it started with a short-term company, and you actually did the research at that point when they did start this whole payback, this cashback bonus thing, and then everybody jumped onto the bandwagon. Looking at how many people actually reach those goals, because they know how many people will claim in a specific period of time. What was those again, so that people can understand?
Like I said now, about 86% of people who make use of a sort of payback scheme through their risk insurance cover never get that payback.
Yeah.
For the simple reason that they did not jump through all the hoops. Looking at short-term insurance more specifically, it's because they had a claim. And that's the reason you have short-term insurance, so you can cover the loss. So what they did is we have to remember, insurance companies have got some very, very smart people.
Oh, yes.
Which they call actuaries. And these people sit down and they calculate probability. So they say, what are the chances of certain things happening? That's how they calculate risk premiums up front in any case. So they had a look at how much claims they do pay out and how long the average person is insured with them. The second and resultant thing that happened from all these paybacks is that people did not claim from the insurance companies anymore, which is great for an insurance company, of course.
Exactly. It's a brilliant business plan.
But instead of claiming now for a windscreen or claiming for a busted taillight or a small little accident, they would rather say, no, I'm going to lose my bonus.
Yeah, I'm waiting for it.
And pay for that out of pocket, which puts them in a worse situation. Remember, again, I pointed out in the beginning that the idea behind risk cover is to put you in the same financial position you were before the actual loss.
Exactly.
And the whole payout bonus scheme ruined the idea behind that. Yeah. It's a money-making scheme for insurance companies. Yeah. And they hate me when I tell them this. but that is the truth.
Yeah. So, and that's the thing. It came from the old universal concept. That was something that was prevalent when we both came into the industry in the late 90s. It was prevalent. A lot of people got to the point, I know, there was the one policy. You take that out with your life cover and then it builds up a cash value. And if you get to age 60 or 65, you get money out of the policy. And it was sort of sold on the idea that if you don't claim before you retire, at least you get the investment value of it. But then people got to retirement and they did the calculation and said, but I paid R1,000 a month into this policy for 30 years. And now I paid in 300, 400,000 Rand into this policy. Now my cash value is only 100,000 Rand. Somebody stole my money because it was never properly explained to people. And that created an outrage because suddenly everybody felt that their money was stolen. It wasn't explained properly. And that was a big contributor to the whole Phase Act that came into being.
And that's why, Lourens, our big focus in minimizing your risk is understanding what the actual financial risk is, how to identify that and how to address that. And I'd like to go into a couple of things you need to look at. All our listeners sitting at home, if you want to do a quick little calculation as to where am I concerning my risk cover, before seeing this little broker running around trying to sell you another policy.
Yeah, that's the snowball effect. And we'll chat about that. We'll quickly take a music break and then we will come back and we'll talk about what do you need to look at to make sure that your risk cover is actually doing what it's supposed to do. How do you make sure that you address your needs? How do you calculate what you actually need for risk cover?
Lourens, like we pointed out, we broadly define risk in two areas, long and short-term insurance. Now, let's start off with short-term insurance. That's probably the easiest place to identify a need and to have a financial value attached to that need.
Quantify the loss, basically, because it's much easier to calculate what something is worth than someone is worth.
Yes, because you can literally go and have a look at what does my cell phone cost, what does my car cost, and insure it for that amount. We have to be very careful when we're looking at things like household contents. Remember, household contents is defined as anything and everything you take with you the day that you move.
Yeah, you've always explained it to me like this. If you could pick up your house, turn it upside down and shake it, everything that falls out, that is household contents. Everything that's stuck to the house will not be household content.
The last important thing to remember there is insurance companies always work on replacement value, new for old. So although your couch is 10 years old and you bought it for 5,000 Rand, the fact that you can now sell it to a second-hand goods store for only 500 Rand does not mean that it needs to be insured for 500 Rand. It needs to be insured for the value of a new similar couch.
Yes.
So short-term insurance, that's rather easy. When we get to long-term insurance, things get a bit more complicated.
Just quickly on that short-term insurance, something I want you to just address as well is how important it is for people to make sure that they are correctly insured for their household goods. And also the things that people don't often think about, the smaller things that needs to be part of their household insurance, like cutlery, crockery, clothing, all of those kind of things. So if you just want to touch on that quickly, how important that is and what happens if you're not.
That's very, very true, Lourens. When we're looking at household contents, like you pointed out, if you turn your house over, everything that falls out, that's your household contents. So people forget about clothes, cutlery, crockery. They forget about the socks in their drawer. They forget about the little thing they have hidden away over here or over there. So what happens if your household contents or your building is underinsured? Basically, an assessor gets sent out at the time of claim. And I'm going to use numbers just to illustrate the point.
It's always easier.
Your household contents is currently insured for 100,000 Rand. You have a claim of 10,000 Rand. The assessor comes out, and while he does a short little valuation, he notices that your household contents should actually be insured for 200,000 Rand. The insurance company then says you deliberately underinsured yourself, which means that you accept the loss or the responsibility for the financial loss of half the claim. In that event, they will only pay out half of your 10,000 Rand claim. So they will pay out only 5,000 Rand. And this is always a very, very big bone of contention with the insurance companies. And this is where people turn around and say, I pay and I pay and I pay, and then I get nothing out. So what people tend to do is they inflate their claims because they know the insurance company is going to not pay out everything.
Yeah.
And this creates this vicious cycle of inflated claims resulting in higher premiums, resulting in people feeling they are paying and not getting any benefit from it.
Means they inflate the claims even more.
So please, guys, when insuring household contents, when insuring your building, make certain you take everything into account. Your clothes, your shoes, kids' clothing, kids' toys, all of those things are household contents and need to be insured for replacement value.
Yeah, and that's exactly it. I mean, we see it so often. It's that scenario of yours. The guy has a 10,000 Rand claim because they stole his TV, and then the insurance company comes back and says, but we're only going to pay 5,000 Rand because you were underinsured. And then the clients think that, but I've got 100,000 Rands worth of insurance, surely 10,000 Rand is less than that, therefore they have to pay it out. So people need to understand how this works. It's a percentage based on how much you then have insured yourself, basically self-insurance that happens there. Another thing that I get a lot, and me and you had a lot of discussion, and then you gave me the answer, and it was like, oh, okay, that makes sense. It's one of the questions that I get so many times on short-term insurance, car insurance specifically, and I think most of the listeners would have thought this to themselves. Why, if my car depreciates in value, do I have to pay higher premiums every single year? Because it doesn't make sense. This year my car is worth 300,000 Rand, therefore I pay 1,800 Rand a month. Next year my car is only worth 270,000, but now I'm paying 1,900 Rand a month. How does that work? So if you can just maybe explain that to the listeners, because I think that's something that was so interesting to me once I understood how this works.
Yeah, Lourens, to get to the actual answer of that question gets very, very complicated. But probably the easiest way to understand it is, yes, your car depreciates in value, but the cost of repairing your car and the cost of the parts required to repair your car becomes more expensive. Why? Because of inflation, because of salary increases. So yes, the total loss of your car would result in a smaller amount being paid out by the insurance company. But total losses of a vehicle, when speaking about the total loss, we're referring to an accident with a car being stolen,
Yes.
where the car is completely written off, is a very, very small percentage of the
total
actual claims that are paid out by an insurance company. Most of the claims, especially when it gets to vehicles, are accidents where the car can be repaired.
Yes.
Again, taking into account that the oak working on your car, the oak spraying your car, the parts required to fix your car become more expensive, the insurance company has to increase your premiums in order to counteract that portion.
So how I understand it, and this will maybe make it even more clearer for listeners, is that if you're paying 1,000 Rand a month onto your car premium, for example, maybe only 200 Rand of that goes for total loss insurance. The other 800 you're paying towards the panel beater, the parts, all of that.
Those usual claims.
Yes. Now that increases with say 10% every year, but your total loss decreases with 10%. But the 10% on the higher premium is 80 Rand, on the 200 is only 20 Rand, therefore your total premium will increase by 60 Rand. So you still have an increase in your premium, although the total loss insurance have reduced. So for me, that was so interesting. Once I could understand that, it just made it clear. So that's something that was interesting to me. All right, you were going on to long-term insurance.
Yes. How to identify the actual financial need when it gets to long-term insurance gets a bit more complicated. So I'm going to use the example of you passing away.
Me?
You.
Okay. All right. I'll pass away for this example. Don't say I don't do things for my listeners.
What we have to remember is it's a physical impossibility to place a value on a human life. So what we need to do is have a look at a potential financial loss and then be very honest with ourselves. Some of the things are easy. when we look at making provision for life cover, first and foremost, we want to make certain that we cover debt. So that's easy to calculate. You take your statements and go and have a look at how much debt do I have.
Yes.
And use that number as a basis. So now we've got the first portion. If you should pass away tomorrow, all the debt can be settled. After that, we need to go and calculate costs. Yes, even dying has a cost.
Yeah.
So we're looking at things like, for instance, how much would a funeral cost? What are executive fees? Transfer duties, master's fees, all of those types of costs.
Setting up trusts for your children, those kind of things.
If need be, yes. All of those things need to be taken into account. So combining those two figures gives us a capital amount of what's needed should you pass away. Remember, again, we're not placing a value on your life. We're identifying the actual financial loss. And the third part is where it gets kind of tricky, because this is where we have to have a very honest conversation as to how much income your family would need should you no longer be around. So we need to sit down and say, right, Lourens, if all debt has been settled and your wife continues working and earns an income, how much income additionally would she need from your side in order to maintain their standard of living?
Yeah.
And maintain is the important word there. We don't want to be in a situation, like I pointed out earlier, where if you pass away, the wife can buy a Ferrari. That's not the idea.
And a mansion on the hill.
Yes.
And get all the plastic surgery she's always wanted.
So by understanding how much the actual income is, we can go and do a calculation to convert that to a capital amount. Probably the simplest and easiest way is to make use of the rule of 300. The rule of 300 basically says that take the monthly amount you need, multiply that by 300, and that should give you a rough estimate of the capital amount needed in order to generate that monthly income for a fixed time period.
Yes. And that's something, sorry, Japie, that a lot of people, they overestimate the value of capital. They think that if I got 3 million Rand, I'll be able to generate 50,000 Rand a month. And that's not how it works.
No, it's not at all. And that's why you need to approach it from a point of need. Because if you sit down and identify the need first, then it's very, very easy to go and compare it with what you have. And like you pointed out earlier, that's where the big difference comes in. It's not focusing on what you have and seeing where I can get it cheaper, or where I can get more bells and whistles, or where I can get an extra little cover here or extra little cover there. It's starting off with saying, this is what I actually need should I pass away or become disabled. And then working from there to what I actually have in order to go and see, do I have sufficient cover?
Yeah, does that actually do what I need it to do?
And that, sorry, Lourens, brings us to our primary and secondary risk areas. Because a lot of people run around with all of these little bells and whistles, like I like to call them, benefits on their policies, educator benefits, and waiver of premiums, and future cover, and so on and so on and so on. All of those things, guys, cost money. It's things you pay for, where you could rather analyze the actual need, and if that need is correctly identified, then address the primary need for risk cover. The secondary things are a lot of times money being wasted. Money you could rather use to invest in yourself, to build assets, which we'll talk about a little later as well.
Yes, so that's very important, to make sure that you actually cover what you need. You know what it is. The problem most of the time is that a risk cover is basically sold on hope. So people run around say, just I hope that if that happens, at least I've got cover for that. The whole approach of focusing on what you need first and then building something that does exactly that takes people from hope to surety. I'd rather know, listen, if this happens, I'm not properly covered for that because of affordability, but at least I know what to expect and where my risk is, than go through life hoping that these things are there, and then it happens, and then I realize that it was never what I thought it was.
That's so true, Lourens. You know, I sit with so many clients, and invariably we end up in a situation where they cannot afford to put sufficient cover in place. But like you rightly say, at least when I finish talking to people, they've got a practical plan. They know what needs to happen next. And they're no longer in the situation of, yes, when I pass away, my wife will have 3 million rand and she'll be okay. They're in a situation where they actually understand what will happen to that 3 million rand, as an example, and what the practical implication would be financially to their wife and kids, or husband and kids, or fiance, or whomever, should something happen to them.
Yes.
Moving away from hope, I hope, to I know.
No, yes. We had a message from Quibus, and his question was, please explain why I have to have a top-up cover and my vehicle insurance. Isn't this double insurance? So why do I need to take insurance and top-up cover? Aren't I paying double for insurance? So I think first explain what top-up cover is, and then you can answer that question for Quibus.
Yeah, Quibus, thank you very much for sending through the question. I think there's a couple of areas we need to address. Why do I have to have top-up cover? You don't have to have top-up cover. It's again about identifying the actual need. So secondly, what exactly is top-up cover? To understand top-up cover, we have to understand how an insurance company values a vehicle and how a bank values your vehicle. So in the first instance, you've got a couple of ways to insure your car when it gets to short-term insurance. You can insure for market value, you can insure for retail, you can insure for trade. Now, without getting too complicated, let's assume your vehicle is insured for retail value. That's the value that it would cost to replace that vehicle with a similar vehicle from a car dealer. But when your vehicle is financed, of course, you owe the bank more than the actual amount that you bought the vehicle for. So the amount outstanding at the bank is more than the retail value. This would result in a total loss happening and you still owing the bank money. So in essence, what top-up cover does is it covers the difference between the amount the insurance company will pay out and what you actually owe the bank. So brings us back to, why do I have to have it? You don't have to have it. If you are prepared, or if you are in a situation where you are able to cover that deficit yourself, it's not necessary to have top-up cover, although it would still be a good idea.
Yeah.
One last thing about top-up cover is monitor the amount of money you still owe the bank. Because as soon as the amount of money you owe the bank becomes less than the actual value, the insured value of your car, cancel the top-up cover.
Yes.
Because it's not going to pay out anymore.
Yeah, so you're going to pay for something that you can't claim on. And top-up cover is a typical secondary risk area, if we look at what you mentioned, primary and secondary risk areas. So what's important is, and I see this a lot with clients that I see, is they've got all of these secondary risk areas that are sold to them, but their primary risk areas aren't even properly sorted out. So that's the ones you first have to sort out. So if you can just quickly share some of the primary risk areas on short-term insurance, long-term insurance, that people need to make sure is sorted out.
Yes, it's also very strange when looking at primary and secondary risk areas, how comfortable people are to take out insurance on their car and insurance on their house, but they forget about the goose that lays the golden egg themselves, their ability to earn an income. And I think it's because having a car accident is a real reality, but passing away is something very abstract, something they don't think about and something they don't want to think about. So, getting back to primary and secondary risk areas. The other
thing as well, sorry, Japie, I'm chipping in there, but the other thing as well is that something like a car insurance or a claim on your car can happen multiple times. So we feel that it's more prevalent, where a death claim, a disability claim even, basically only happens once in your life. So
it feels like only pass away once.
Yeah, exactly. So, and people feel, it's still going to be years from now. Nobody thinks, okay, tomorrow is going to be my last day. And I'm clocking out tomorrow.
Yes.
It's a once-off event that will happen somewhere, and that's why people tend to spend more money on the short term than they do on the life cover.
It's very, very true. So getting back to our primary risk areas, when looking at short-term insurance, our primary risk areas would be your household contents, your building, and your vehicle. Those are the things that enable you to actually live in order to maintain a standard of living, a semblance of living. Your cell phone, your laptop, all of those things would be secondary risk areas. Yes, if your cell phone gets stolen or falls off the table, it is going to affect your life, but not in remotely the same way having your car stolen or your house burned down is going to affect your life.
Yeah.
So look at the basics first, always.
Yeah. That's it. We're not saying to people, don't have your cell phone insured or don't have your laptop insured. We're saying first make sure that your primary areas are sorted.
Correct.
And then if you can afford to take out the cover on your cell phone or your laptop, then do that. But don't focus so much on your cell phone that your household goods is underinsured and you have that problem.
That's very true. And that, of course, brings us to long-term insurance. When looking at long-term insurance, your primary risk areas should be death, disability, income protection, and dread disease. Those are the things that are what we call life-changing events. Things you need to make certain are covered. After that, we look at future cover. We look at educator benefits. We look at waiver of premiums. Because, again, those are things that if you did your primary areas correctly and you identified the need and calculated it correctly, there would be no real need for it.
Yeah, and that's something that under secondary risk benefits as well. I see this quite often, especially in these times when people try and cut expenses. I get so many clients that phone me and say, geez, is there a way that I can reduce my life cover, my disability cover, those kind of things, because I can't afford all of this cover anymore. But they spend 5, 6, 7, sometimes over R1,000 a month on credit life insurance, on their credit card, their car loan, etc. But they don't think about cancelling that. They focus on cancelling their main insurance cover. So credit life is a typical secondary risk area, and give the listeners your thoughts on where credit life fits in and if it's worthwhile.
Short version, no.
Yeah.
Guys, credit life. A lot of us don't even know we're paying for credit life. When your bond gets approved, when your finance on your car gets approved, when you get a loan from Edgar's or from Fushini to go and buy clothes, usually we're so happy that we just sign the paper and go, yay, at least now I can do this. A lot of times credit life is included in that. When we're referring to credit life, it's a version of life cover and or disability cover. I call it a version of because it's not underwritten. So they grant you this cover without really knowing who you are and what's happening to you. This results in underwriting happening at claim stage. So when you pass away, you end up in a situation where they now all of a sudden start asking questions. And a lot of times credit life does not pay out because of what they deem pre-existing conditions.
Yeah.
Oh, you did not tell us you have a heart condition. Well, you didn't ask me. And at the end of the day, it does not pay out. Again, if we go and do our primary areas correctly, if we sit down and say, what is the debt we have? How do I make certain that should I pass away, all of the debt is covered? Then credit life is not needed. And credit life is also probably the most expensive life cover you can have.
Yeah.
If you go and calculate per 1,000, it is ridiculous how much you're paying for credit life.
Yeah.
So guys, have a look at the accounts you're paying. Have a look at the outstanding debt, the credit cards, the overdraft, all of those things. And if you're paying for credit life, rather contact your financial advisor, contact us, and let us help you put together a practical risk management plan which addresses the primary needs and provides a practical plan for that.
Yeah, and that's so important is if you want to start cutting expenses, don't start with your primary risk areas. Start with your secondary risk areas and start cutting back. People tend to, the first thing they want to cancel is their life cover and their disability cover, because again, they think it's not going to happen. It's only going to happen in years from now. And the thing with that kind of insurance is it's like a parachute. If you don't have it the day that you actually need it, you're probably not going to need it again. So it's important to have those things in place.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.